Hi everyone and welcome to Startup Issues. In this recording, we are going to discuss about what all things you need to be careful about when you're starting a business. Okay. So first is choosing a business name. So what is the purpose of business name? So business name is a unique identification of your business. And it is also important for tax purposes because your business would be taxed on the particular business name that you provide. Now there are different forms of business, like there are different forms in which you can set up your business, and we have discussed it in the last recording. You can have it as a sole proprietorship. So if you're starting a business as a sole proprietorship, you need to do a name search to give a name to your particular business, then do documentation of that name and pay the fees to the provincial authority. So businesses are registered provincially, so you have to pay, or they can be registered federally too, but sole proprietorship are mostly provincial, so you need to pay fees to the relevant provincial body. Then you can set up your business as a partnership. If it is a general partnership, the process is same. You need to do a name search, you need to document it, and you need to pay the fees. But if it is established as a limited partner, limited partners are where partners are just coming as an investor. They are not coming in to run the business. So if you are a limited partner, limited partners cannot use their own name in partnership. So the partnership cannot be named after limited partners. So you have to be careful about that. Now, if it is a company, if it is an incorporated company, choosing a corporate name is little bit different. So choosing a corporate name cannot be similar to other corporations. So your name should not be exactly same as some well-known corporation, as well as it should not be similar to. So let's say Hudson Bay is a company that is there in Canada. So your business cannot be named like Hudson Bay Calgary. You cannot have that. So similar names are also not allowed. You have to file the nuance report. So nuance reports is a way of searching names in Canada. So you need to file the nuance report to get whatever names are available similar to your name. Corporate name may contain extensions, and they generally do contain extensions like limited, incorporated, etc. You cannot use any government related name. So you cannot have a company like RCMP Limited, or you cannot have a company Alberta Crown Companies Limited. You cannot use any government name. It can be in English, and if you're in Quebec, it can be in French. So the name can be in English or it can be in French. You can also get a numerical value from the government and use that numerical value as your name. Now, changing name of a corporation is very tedious and you should not do it, because when you change corporate names, you need to notify your customers and suppliers that your name is changing. You need to change websites and other contact details that you may have. You need to change legal and financial documents. So most companies have letterheads where they can do some official documentation. So if you're changing your name, you have to change all the letterheads, and you have to change the name in your bank accounts too. So choosing the right name is important, because changing it later on is very difficult. Means it's possible, but it's very tedious to do it. Now, license and permit. Sometimes your businesses may need licenses to operate. So example will be, if I want to start a pharmacy linked business, I want to start a pharmacy business. So I need a pharmacy license to operate it, right? And all my employees would also need pharmacy license to operate as a pharmacist. So you need to figure out who needs the permit. Do you as a owner need permit? Your employees need permit? Your equipment needs permit. Sometimes if you're operating heavy machinery, you need to get permissions for that. Or if you're handling nuclear waste, you need to get permissions for that. If you're a waste disposal company and you're handling hazardous materials, then you need to get special permissions for equipments to use it. or your business itself may need certain permissions. So you need to figure out who takes permits. Example could be a liquor business or a cannabis shop. So cannabis shop, the business itself needs permission. Now types of permits can be federal permit or it can be provincial permits. Obtaining licenses and permits, check which licenses you need. Determine requirements of those licenses. What are the different requirements you need to fulfill in order to get those licenses? Filling out the relevant application. You need to fill provincial or federal applications in order to get those licenses. You have to wait for licenses. It generally takes time, so you need to properly plan it. And write a note on step by step. Okay, this is part of your assignment. So in that assignment, you need to write a note on step by step process of acquiring a liquor license in BC. So this is part of your assignment. Financing your small business. So financing your small business includes equity financing, selling ownership, or it can be debt financing, that is taking on a loan. So what is financing of small business? So you need money to start the business, you need money to expand the business. Now where do you get this money from? So either you can do equity financing, in which you sell your ownership, right, to friends, families, other business people or institutes. You sell your ownership, that is equity financing. Or you can do debt financing, in which you take on loans. Okay, when you take on loans, you have to pay back the principal, whatever you have borrowed, plus you have to pay back interest. In equity financing, you don't have to pay back anything, like you don't have to pay back principal or interest. You give up ownership in your business. So that ownership includes dividends, that is share of profits. Share of profits are called as dividends. So you may have to give certain dividends, or you may be able to, like, they get ownership, so they may be able to sell that ownership to someone else or to you back as a company. So sources of equity financing, it can be yourself. You can sell ownership of a business to your own self, put in your own capital, become 100% owner. You can sell it, or you can take money from family and friends, where you give out certain ownership to family and friends. You can give it out to other business people. So influential people that you know, you can take money from them. You can give out your ownerships to institutions, and you can give out ownership to government, and you can give out ownership to overall public. So institutions are generally financial institutions, venture capitalist funds, angel investors. You can give your ownership to them and borrow money, like take money from them. You can give it out to government. There are certain government schemes where you give out ownership, like they take ownership in your business against some money. Or you can give out ownership to general public, so investing public. You can do a public offer, but the process of public offer is very tedious. You have to go through the entire IPO, initial public offering process. Now, which kind of common shares can you offer? So you can offer common voting shares. Common voting shares means each share has a voting right as well as ownership in the business. So voting right means the people who get common voting shares, they participate in the decisions of the business. So they participate in process of appointing directors. They participate, like if there is a merger or acquisition of your business, they participate in those decisions too. You can also give out non-voting, non-redeemable dividend bearing preference shares, in which you don't give out voting rights. So these people who are buying these shares from you, preference shares from you, don't get voting rights. They are not redeemable. So you don't have to give the money back that you have taken from them. So they cannot be redeemed, and they pay dividend. So whatever profits you make, out of that profits, you have to pay them some dividends. Or it can be non-voting, non-redeemable preference shares, which can be converted to common shares. So they have a conversion option. Next is private companies. So As a small business, you are not a public company. You are a private company. Public company means your stocks are listed on a stock exchange and you have done a public offer. But most small businesses do not do public offers because the process is very tedious. So security legislation restricts you from offering shares to public. So as a small business, you cannot offer shares to general public. You can create a private company though, so there is a provision for that, in which right to transfer the shares of the company can be restricted. In a private company, it is restricted. You cannot keep on offering shares to anyone. The number of shares should be less than 50. Shareholders should be less than 50. You cannot have more than 50 shareholders. You cannot invite public to subscribe for shares. So you can do private placements, you cannot do public placements. What is private placements? You can sell your stock to venture firms, financial institutions, or other rich entities, but you cannot sell it to general investing public. Debt financing. Then debt financing is where you borrow a loan. So you borrow principal. Let's say I'm taking a $100,000 loan. So I'm borrowing $100,000. Now against this borrowing, I'm not giving up ownership. What I'm going to do, I'm going to pay regular interest. So loan is where you borrow a principal and you pay regular interest. And when the loan matures, you pay back the principal. So borrowing can be done from your own self. So you can lend money to your own company. You can lend money from, you can borrow money from friends and family. You can borrow money from other business people. You can borrow money from other institutions, and you can borrow money from government. Now, what are the different types of loans that are available? So there are operating loans, term loans. So what is an operating loan? Operating loan means to operate a business, sometimes you have to borrow money. So whatever money you borrow to operate a business, not like capital, like not for buying machines, not for expanding, that is term loans. Operating loan is to just run the business. So those are called as operating loans. So whenever you borrow money to operate your business, day-to-day operations, that's called as operating loan. Now they can be revolving line of credit. Revolving line of credit means you can borrow, right? Generally, there is no specific purpose for that borrowing. Revolving line of credit means no specific purpose. They just extend you a blanket borrowing. So example, I may get a revolving line of credit from RBC. RBC is my business bank. So I may get a revolving line of credit from RBC where I can borrow $100,000 up to $100,000 from RBC. Now that borrowing need not have a specific purpose. Non-revolving line of credit has a specific purpose. So when you take a non-revolving line of credit, you have to mention the purpose for which you are borrowing. Then there are inventory loans. Inventory means goods or services, generally goods that you have for selling, right? Goods that you have built up to sell, that is inventory. Now you can borrow against that inventory. Okay, you can borrow against that inventory. Inventory is goods that are to be sold. Account receivables are goods that have already been sold, but you haven't received money for them. So you can borrow either against inventory, goods that are to be sold, or you can borrow against account receivable, in which you have sold the goods to the customers, but you haven't received the entire money from them. Then you can take term loans. Term loans are for expanding, buying machine, doing R&D, for any other purpose. Now term loans are generally 5-year loans, 2-year loans, where you borrow money for 5 years, 2 years, etc. Now whenever you take loans, documents that establish the loan terms generally include principal, the amount that you are borrowing, interest that you are going to pay, payment dates. Payment date means when are you going to pay in that loan, like what are the payment dates of that loan, what are the payment dates for interest, what is the payment day for principal. Then collateral. Collateral means things you're borrowing against. Now they may include certain restrictions. So restrictions can be that you cannot borrow more, you have to pay back before filing for bankruptcy. All these restrictions can be put by banks. Or it can be a promise, and you need a promissory note in which you promise the bank that you will pay back that loan. Now loan collateral is something that you put, right, as a collateral in front of the bank against which you borrow. So loan collaterals can be, collateral means you're giving something to the bank for safekeeping and you're borrowing against that collateral. Now collaterals can be secured under general assets. So whatever assets you have from your business, you can take a loan against them. Or you can have specific assets. Those general asset loans are called as debentures. Specific asset loans are called as bonds. So let's say my business has like a factory, few cars, transportation trucks, etc. So I can take a debenture against all these assets. Or against my car, I can borrow some money. So if I do that, that is against specific assets, hence it is called as bonds. Loan collateral can be account receivables. So account receivables are sales that are already been done. So you have sold something, against that you can borrow money. It can be inventory. Inventory means things that you have not sold, you can borrow against that. Conditional sales contract. So if you have sold something conditionally, you can borrow money against that. You can pledge your shares. You can, if you have some shares in your business, you can pledge those shares and borrow against it. Real property, you can borrow against factories, cars, etc. You can borrow against land, the land that you own. You can borrow against a lease. So if you have given some lease to your customers, you can borrow against that. You can use an external guarantor for borrowing money. So maybe if your friend guarantees your loan and you can borrow like that. Or you can take a letter of credit from a bank in which bank becomes the guarantor. So bank, if you're a very loyal customer of a bank, banks generally provide you letters of credit. That letter of credit you can use to borrow from any entity. Now there are certain conditions that the banks or lenders can put. Those could be, most of the lenders mandate that you have insurance for the business. So if they are giving you money, they may ask for certain insurance. Then they may ask you to give certain control of the business. And this generally is a condition when you don't pay. If you don't pay, they may get control in your business. Then there can be an intercreditor agreement in which if you are borrowing from two or more creditors, two or more banks, then those banks can do an agreement between themselves on who gets paid first. Or banks or financial institutions can ask you to value your assets, do business valuations. Now government financing can be done by taking a loan from Business Development Bank of Canada, and it is part of your assignment. So you need to write the process to take a loan from Business Development Bank of Canada. Then you can take financing as a grant. Loan you have to pay back. Grants you don't have to pay. So grant is like some additional aid to grow your business. It can be equity programs in which government takes part of ownership of your business, or it can be provincial venture funds that fund you. Next is insurance. Now when you run a business, it is important to look at insurance. Now what is insurance? Insurance is if something bad happens, then you get paid. So insurance is a conditional contract. If a condition is met, then the insurance company pays you. If the condition is not met, then the insurance company does not pay you. Now to get this conditional contract, you pay insurance premiums. Now, what could be the conditions? Conditions could be loss of asset, loss of business, someone sues you, anything, right? So if the condition is met, the insurance company pays you. Now either you can do self-insurance. Self-insurance means you do not do insurance, but you allocate money if something goes wrong. So you create an emergency fund, allocate funds to that account, and if something goes wrong, you use that fund. Or you can buy an insurance from an insurance company. Now insurances can be costly, so you need to determine what is the probability of risk and what is the amount of risk. So what is the probability of things going bad, and if things go bad, what is the loss that you maximum loss that you may suffer, and based on that you have to take a call whether you want insurance or not. Now type of insurance that are available, you can have a property insurance in which you insure your property. So it can be a factory, it can be some office space, you can buy insurance for that. You can buy business interruption insurance. Business interruption insurance means if your asset is destroyed and business is impacted, then they pay for that impacted business. For example, if I buy a property insurance on my office, in my office space, and if the office space gets destroyed by the fire, property insurance will only pay for destruction of property. It will not pay for loss I suffer because of destruction of property. Business interruption insurance pays for the business loss that you may suffer because of loss of some kind. General liability insurance, this is very important and most businesses have this. General liability means if anyone sues your business, so let's say you are having a you're a car mechanic and you forgot to shovel your snow, and someone falls down and someone sues you, then you may be in trouble. So general liability insurance protects from that. General liability insurance protects from any external party suing your business. Then key person insurance protects some key people in the business. For example, Tesla is a business that is run by Elon Musk. Now Elon Musk is very important for the success of Tesla. So Tesla has a big key person insurance policy on Elon. So if something happens to Elon, Tesla gets paid. Then you have directors and officers liability insurance. So in Canada, there are different laws that make directors and officers accountable for certain things. For example, if your business is in trouble because it is creating pollution, then your directors and officers can be sued by the government. There can be a class action suit. So in that case, directors and officers liability protect your business, not your business, but those directors and officers. Environmental liability insurance protects business if you are handling some hazardous material. So if you are in a waste disposal business, you should probably think of getting it. Credit insurance protects you from default of creditors. So let's say you are doing business on credit. You have a lot of customers who take credit from you. So you are a lender. And if they don't pay, you suffer loss. So you can take credit insurance for that. Cyber security insurance, anything that can, like if you get hacked or you have a breach in online presence, then that insurance pays you. Credit insurance we have already covered. Cyber security insurance also. I think I have typed it twice. You should be careful about insurance that you do not misrepresent any fact. So there is a clause in insurance called as material fact misrepresentation. So if you misrepresent material facts, then the insurance company can deny your claim. And if you are dishonest, so if you have done some fraud or if you put some fraud claims, then the company can deny your claims or deny you future insurance coverage. So you have to be careful about it. So that's it. See you in the next recording.